we have familiarized ourselves with some numbers which indicate how much percentage of analysts use the discounted cash flow techniques. And out of the use of discounted cash flow techniques, we have seen that free cash flow valuation is used by more than 86% analysts for their analysis of a stock or for analysis of the firm. Okay, so free cash flow valuation, how it is different from the dividend valuation. Dividend is also cash flow. So one particular thing we like to highlight that dividend is a readily available cash flow number. Company board of directors declare the dividend and you know the dividend amount and that is readily available. But free cash flow valuation, although used by and preferred by most of the analysts and weighted heavily in the valuation report, but free cash flow number, particularly this free cash flow number, is not readily available number. Okay, so analysts have to work more, or analysts have to work a lot to find out the free cash flow numbers, projected free cash flow numbers. So when they need to come up with the free cash flow numbers, you can easily understand that which one seems more challenging between the dividend and the free cash flow. So obviously, when you need to come up with some number which is not readily available, it will be more challenging. So that's why people, if their effort and money cost do not support or are not adequate enough to have the free cash flow valuation, they do not go for making this. Okay, so always valuation needs to be used based on your cost and based on your purposes and based on the values you will want to derive. Okay, so you can recall that in the dividend cash flow valuation techniques, we discussed what are the areas or what are the reasons for which the free cash flow valuation might be appropriate for the valuation technique. Okay, so we have to measure the free cash flow valuation, but we have to understand the definition of the free cash flow very first. So if we understand the free cash flow definition very clearly, in that case it will be very much straightforward that what we need to think of to estimate the free cash flow. So we use the two definition of free cash flow. So one is the free cash flow to the firm, which we will shortly or use the acronym in short as the FCFF, and there is another definition of free cash flow, which you will define as FCFE. Okay, so free cash flow to the firm and free cash flow to the equity. So we understand the free cash flow is the cash available to all suppliers of capital to the firm. So suppliers of capital provide capital to the firm. And what is the cash available to all the capital suppliers of the firm? Okay, we know that common shareholders, debt holders, preferred stockholders, they provide capital to the firm. So cash flow available to all of these parties will be known as the free cash flow to the firm. Okay, so how we measure it? So we understand that when we have the cash flow from operations by subtracting the operating expenses from the operating cash or operating cash disbursement, we subtract this from the operating cash received. We have the operating cash flow available. Now, what we need to do? We need to make an allocation. Make an allocation for what? Because we need to make allocation for the sustainability of the firm. So how farm will sustain? Farm will sustain if we sustain the capacity or productive capacity of the farm. So how can we sustain the productive capacity of the farm? If we make investment in working capital or current asset, in that case, farm will sustain. However, in addition to this, we need to make investment in fixed asset, which is popularly known as capex or capital expenditure, long-term investment farm needs to make. If farm do this or farm does this, in that case, farm will be able to sustain. So what I was saying, the operating cash flow or cash flow from operations is used firstly for these purposes which are essential for sustainability of the farm. That means working capital investment and fixed asset or capex investment. After making this investment, we can say that this cash, the remaining cash, is available for the capital providers. So capital providers includes stockholders, debt holders, or the preferred stockholders. Okay. Now let's use the same understanding to understand the free cash flow to the equity. So here you see that after making allocation for sustainability of the farm, for working capital and the fixed asset investment, out of what? Out of the cash flow from operations. After making this investment, working capital, then capex, after making this investment, what we need to do? We need to allocate the cash flows for the debt holders. We need to allocate the cash flows for the preferred stockholders. Then what is remaining? The remaining amount is for what? If we make allocation for this, if we make allocation for this, the remaining amount is available for the common stockholders. Okay. Now, so you see how they are different. Okay. So one is for free cash flow, which is for all capital providers of the firm. And another one is free cash flow available only for the equity holders. Now, do not try to understand that free cash flow can be readily available from the financial statements of the firm. Okay. So from the financial statements of the firm, you cannot get the free cash flow. You might think that the cash flow statement provides the cash flow from operations, or you might think that EBIT from the income statement, and if we add the depreciation and amortization, EBITDA is a good proxy of free cash flow. That will not be a good thing. Okay, so we cannot use this because they are actually not the precise definition of the free cash flow. And we see that when we have the EBITDA, does EBITDA reflect that we have made investment in our productive capacity? This EBITDA, when we have the EBITDA, does it indicate that this has taken the investment in the productive capacity of the firm into account? What do you think? If we have the EBITDA, no. So in that case, EBITDA can be a proxy, but it cannot be. It is not the right definition of the free cash flow, but it might appear that it is a proxy of free cash flow. Okay. Okay. So let's proceed. We have understand the basic definition of the free cash flow, and we like to see that how we come up with the equity value. We use the free cash flow to the firm, or you use the free cash flow to the equity. How can we come up with the equity value? Okay. So in any way you can come up with the equity value. Okay. Now, if you have the free cash flow to the firm, if you have the free cash flow to the firm, you see that firm has received capital from which capital providers? Again, equity holders, debt holders, preferred stockholders, right? Okay, for simplicity, I'm assuming equity holders and debt holders. Okay, so in that case, we have to, as the free cash flow to the firm is available for all capital providers. In that case, we have to discount it by cost of equity or something which represent the combination of cost of equity and cost of debt if the numerator is free cash flow to the firm. Okay, so the answer is work. The answer is work. Now, when you have calculated it, you have the firm value because you have taken the free cash flow to the firm as a numerator and you have discounted it back by the work. What you have the firm value, okay, or value of firm. Value of firm. Now, what you need to do to get the equity value? You need to subtract the net borrowing. You need to subtract the net borrowing, or alternatively known as net debt. Okay, so try to understand what is net borrowing or what is net debt. Okay, now forget about other things. Say in our statement of financial position, I have the debt amount of 500 and I have the cash balance of 200. Okay, now think of a situation where capital and liabilities, and here the assets. Okay, now think of a situation I have no other asset other than this cash of 200. Now, how much debt I can make? How much debt can be repaid by my available cash balance? I can make repayment of maximum how much? With my cash balances, 200. With my cash balances, I can make repayment of 200. In that case, what is available? What is the remaining debt? This 300. This 300 is known as the net debt. Okay, this 300 is known as the net debt. Okay, the debt value adjusted for the cash balance. Now, what we have to do? We already have calculated the value of firm, and we have to subtract it. We have to subtract the net borrowing or the net debt from the value of firm. Okay, so note that the equation is like that: value of equity is value of firm minus net debt. Okay, but if you do not make if it is debt to you, in that case you have to add cash here and you have to write the value of firm here in this way. Okay, so you see the summation of these two, this is the minus and this is the plus. Okay, so summation of these two, cash minus debt, is equal to net debt. Okay, you can use either of the approach. So what we are trying to see, we are trying to see that after subtracting this one, the net borrowing or net debt from the value of the firm, we can come up with the equity value or the value of equity. However, if we have the free cash flow to the equity, if we have the free cash flow to the equity, if we have the free cash flow to the equity, now this is available or this cash flow is available to all capital providers or equity holders only, based on our previous understanding. It is only available to the equity holders. In that case, which is the appropriate cost of capital or discount rate for the equity holders? The answer is the cost of equity, not the WACC. Okay. So someone is asking that whether we should account the current portion of the long-term debt. Current portion of the long-term debt. Yeah, that should be part of the all debt value, or that should be part of the debt. Okay, when you take into the account of debt, you have to take all the current portion or the long-term portion in your value of debt calculation. Okay, so let's proceed. But before that, let me ask you, which one you will prefer? You will prefer the free cash flow to farm valuation, or you'll prefer the free cash flow to equity valuation, or you have no preference of one over another? You prefer the free cash flow to the farm over the free cash flow to the equity. One classic reason is that sometimes or often we find the free cash flow to equity as negative. Free cash flow to equity is negative. In that case, free cash flow to the farm can be a good option to use. Another issue which is related with the volatility or the instability of the capital structure. So if the capital structure is unstable, in that case, you will often find it difficult to calculate the RS. Can you recall this one from your capital investment decision course? RS, cost of levered equity. Can you recall the cost of levered equity, RS? I believe you should recall. Yeah. So you see that we do some calculation for getting, we do some calculation for getting this. I'm not writing it, assuming that you know it. So you see there is an implication of debt to equity ratio, right? There's the implication of debt to equity ratio. So when this is unstable, this ratio is unstable, you do not have the idea that what is going to happen. Okay. In that case, the calculation of the cost of equity, cost of levered equity is particularly challenging. Okay. So that's why as free cash flow to the farm uses the WACC, and that is more easier to handle this kind of issues. Okay, so when the capital structure is capital structure is unstable. Okay, so these are the issues. Let me show you in terms of equation what we are trying to do. Okay, so it is same as what we already have discussed, that if we have the free cash flow to the farm, we will discount it by WACC. And if we have the free cash flow to the equity, we'll discount it by cost of equity. And one thing which is the backbone of the discounted cash flow techniques is equity value here, or the farm value here, is sum of all the sum of the present value of all future cash flows. So we are summing up all the future cash flows by making the present value in today's term. Okay, so we have a stream of free cash flow to the farm, or we have a stream of free cash flow to the equities, and we discount it back to get the free cash flow to the farm valuation, or the valuation for equity, the final number. Okay, so let's try to proceed the single stage free cash flow model. Can you recall this, that we use the forecasted dividend for next year, and we use the cost of equity, and we subtracted the growth rate. Where we have used it? We have used it higher in the dividend class or dividend valuation class in a single stage model. Where this model is the reflection of, or this model has been developed by which author? Myron Gordon. Okay, so you are becoming senior, so you need to mention the GGM. Yeah, GGM is the acronym, but you will mention it was developed by Myron Gordon during the period 1800. Okay, so what I want to see, or do not try to understand that the Gordon growth model is particularly applicable for the dividend discount model, okay, or for the dividend discounted dividend valuation. Okay, but I want to stress that Gordon growth model is also applicable if we use the, or if we see that free cash flow to the firm or free cash flow to the equity is a stable number. Okay, so here in the single stage, we see that if we have a proof, or if we have evidence that free cash flow to the firm of this company or of this firm is expected to grow at a stable rate or at a constant rate for foreseeable future, in that case, it is obviously safe to use the single stage or the model provided by the Gordon growth for the free cash flow valuation. Okay, so here you see that we still have the growth rate. Now, what is the definition of the growth rate here? Is the definition same, or this definition of the growth rate has changed when we are using the free cash flow? What do you think? Can we expect that the dividend growth rate can be taken as a G here, or we have to think differently here? What will be the G here? G indicates what here? If you understand the G from the dividend, discounted dividend valuation, you can understand that what G will indicate here. Yeah, the answer is the G here is not the growth of the, G is not here the growth of the dividend. G here is precisely indicating the growth of free cash flow to the firm, or G here is indicating the growth of the free cash flow to the equity. Okay. Now, do you think the growth rate of the free cash flow to the firm and growth rate to the free cash flow to the equity will be similar or same number, or it will be different? What is your guess? The growth for free cash flow to the firm and the growth for the free cash flow to the equity is expected to be different, right? Okay, now let me give you some numbers just to remind you that how we come up with the W1. Okay, so you see some numbers for the using the single stage growth model, but here what we have to do, we have the current free cash flow to the firm. Try to understand, is the free cash flow to the firm, but that is current. Okay, now next thing, target debt to capital is the 0.25. Before trying to discuss on the remaining issues, let me stress here on this 0.25. So we, or analysts, often use the target debt to capital ratio. Analysts often use the target debt to capital ratio in estimating WACC, okay, or in estimating the future debt level, whatever it is, future debt level or for the WACC level, which one they use, the target debt to capital instead of the current debt to capital reflected in the balance sheet. Current debt to capital reflecting in the balance sheet, instead of using it, what they use the target debt to capital. Can you tell me what is the intuition for using the target debt to capital instead of using the current debt to capital for estimating the leverage? What is your intuition that why analysts use the target debt to equity, target debt to capital? Yeah, absolutely. You have the right intuition. In the long run, firm will try its best to reach the target structure. Okay, so it is not the current which they will try to continue. As long as their target is different, they will try to achieve this. Okay. Then we have the market value of debt, we have the share outstanding, we have the required return on equity, we have the cost of debt, we have the long-term growth in FCFF, long-term growth. So you get a smell that it will grow at a stable rate, right? That's why you see a single growth rate. You do not see a multiple numbers for growth rate. Okay, the tax rate 30%. Now, so let's try to come up with some number for WACC. So how it is possible? If we have the target debt to equity, debt to capital, we know that we have this debt ratio, debt to capital 0.25. Understand the capital definition is here, equity or debt plus C. Sorry, debt plus equity. It's the definition of the capital here, right? Okay. So we have taken the debt ratio, target debt ratio, and to get the cost of debt, what we need to do? We need to take the cost of debt 7%. So this 7% is before tax or after tax? It is before tax. We have to adjust it for after tax. For what reason? It provides us tax advantage. After tax cost of debt is the actual cost of debt. Okay. So if the target debt is 0.25, target equity is 0.75. We have been given the required return on equity is 12%, so we can use it directly. So if we use it, how much we should have for the WACC? How much WACC we should have? We have the number. Any number? I do not see any number. So let's come up with the number. That should be something like how much? Some people are giving me 10.23, some are giving me 12.22. So which one I should take? Okay, so let's take the 10.23. 10.23, right? Okay. Now we need to find out the value for what? The value for FCFF1. FCFF1, what is it? It is the projected projected free cash flow to the firm for next year. So we have this number. for current year. So we have the projected free cash flow to the firm for how much? Is there any growth rate? There is a growth rate. Which one? 5%. So we can take the 0.05. So we have the numerator here. And what will be the denominator if this is a single stage valuation for free cash flow to the firm? Okay, so we have the work of how much we already have calculated, 0.01023. We should subtract it for 5%, that is the G. Okay, what we are doing here, we are doing the calculation of value of firm based on assumption that there is a stable growth rate. Okay, so we see that it should be 10.23%. We already have done, and here probably there's a mistake. It should be 1023. Okay, so let us calculate this. What is the value of firm here? Try to think of it is the 6 million. Try to think of it is the 6 million instead of writing the full number. 6 into 1.05, then divide by 0.1023 minus 0.05. So what should be the value of firm? Do you have the number? The number is around 120 million. Okay, the number is around 120.5 million. So let me write here as a 120.5 million. So we have this value for what? Value of firm. Okay, now we have the market value of debt. We have the market value of debt. And what can we do? We do not have any cash balances. What can we do? We can subtract the 30 million value from the 120.5 million value for getting the value of equity. Okay. So let's see. The number is 90.5 million. The number is 90.5 million. And this is the equity value. And if we have the number of shares, what can we do? We can we can divide the equity value by the number of shares, outstanding shares, to get the equity value per share. Now, someone is asking that how can we make adjustment for the repurchase of share? In that case, you see that for the repurchase of share, what will be the consequences in the valuation? Okay, so you see for the repurchase of the share, your cash outflow will happen, and again your number of shares will go up, and you have to make adjustment for this to get the equity value after making the repurchase. And again, the repurchase is not something that can be projected or that can be predicted precisely. So it's a kind of based on some empirical evidence. We talked about in class that based on the performance in 2 years, good performance in 2 years, firm may engage in repurchase. So you have to make adjustment where the repurchase will make the effect. Okay, so this is the very basic understanding, and you have to make some adjustment when some adjustment is necessary. Okay, so we have to start from here, and that is the very basic. Okay, nothing else here still now complicated. Okay, now as I was saying that free cash flow calculation is challenging, and it is challenging not only for number of variables involved in estimating the free cash flow, and it is also challenging because you have to estimate the variables, as we have to estimate the projected free cash flow, not the historical free cash flow. Okay. So right now what we are doing, we are trying to see the alternative definitions of free cash flow. We are trying to see alternative definitions of free cash flow, or how can we actually come up with a free cash flow number from our financial statement number or from our projected financial statements. Okay, so what can we do? We have some numbers either from our historical financial statements or from the projected financial statements. So how can we use the numbers available in the financial statements, either in projected or in historical, to estimate the free cash flow to the firm? Okay, so you have to make adjustment to find out the definition of the free cash flow to the firm. Do not forget the definition. It is the cash flow available to all the capital providers. Okay. From the cash flow from operations, after making adjustment for what? After making adjustment for investment in capital expenditures, investment in working capital, which are essential for keeping a firm sustainable in its operation. Okay, so let's see this definition of the free cash flow to the firm, and that is very basic definition of the free cash flow. And I believe you have come up with some definition of operating cash flow in your capital investment decision course. This one, net income plus depreciation. Okay, this is a proxy of operating cash flow from the financial statements. So what we are doing, we see that net income is something which is available to the, if we do not have the, it is available to the equity holders. Okay, net income. It is the last item in the income statement, and it is available to the equity holders. Okay. We are not thinking of other complexities. Just for simplicity, it is available for the equity holders. Now, this net income, we know that it has adjusted, or it has, and this net income has become available to us, but this net income is calculated by subtracting some expenses which are not cash. Those are non-cash charges. That is the NCC, not the NCC. It is not the National Credit and Commerce. This is the non-cash charges. So it includes the depreciation, it includes the amortization, it includes other things, amortization of bond premium or amortization of bond discount. You have learned about the how to amortize the bond discount or the bond premium in the financial statements from your course financial reporting analysis, right? So you see that how you make the disclosure in the financial statements. Okay, but in sum up, all these are non-cash charges. So we have to add back non-cash charges. But if there is something which is non-cash receipt, there are some items which are non-cash receipts. In that case, you have to make you have to subtract those items. Okay, so in netting, or by making all non-cash receipt and non-cash charges, we usually have non-cash charges. That's why we add back all the non-cash charges, because that is not the cash outflow. Okay. Now, what we have to do, usually the common or very basic item under the non-cash charges, and which often you will see, is the depreciation and amortization, right? And you know that depreciation and amortization is something, the accounting treatment, that how we can recognize the purchase cost of equipment and make the allocation of costing over a period of time in the economic life, right? And in addition to this, what we have to do, we have to add back the expenses paid to the debt holders. So what is expenses paid to the debt holders? That is the interest after tax. It is for whom? It is for the debt holders. So it is for the debt holders, and you see it is for the debt holders, these charges, and we have to add back here. So why we are adding back? Because it has been subtracted, the interest expense has been subtracted to get the net income. So we are estimating the free cash flow to the firm for as a proxy of cash flow, which will be available for all capital providers. Okay, so we have accounted for cash flow which is available for equity holders. Now we have to account for cash flows available for the debt holders, right? So that's why you have added back. Okay, try to understand. Otherwise, if we want to memorize this, that how this equation works, we'll forget some symbols, or we'll forget some variables, and we'll end up something wrong. Okay, so we are adding back because this amount is available for the debt holders, and by definition, the free cash flow to the firm is the cash flow available for equity holders and the debt holders. Try to understand. When I have said it is for the equity holders, we have to make some adjustment. Still now, it is not altogether available for equity holders. We have to make adjustment for capex and for working capital investment. Okay, so the basic definition for the equity holders and the debt holders is here, and we have to make adjustment because this is the definition of operating cash flow or cash flow from operations. So when we subtract the investment required for fixed capital or long-term investment or capex, we have made investment here, which is the investment in fixed capital, and investment in working capital. So when we make adjustment for this, after making adjustment for this from here, now the remaining cash, try to skip this part right now. Try to understand that when we make allocation for this from this, now this is available for what? Available for the equity holders. Okay, and we have this amount available for the debt holders, and all together they are indicating the free cash flow to the firm, or this cash flow available for the capital providers. Okay, so here what we are doing, we're subtracting working capital investment. One caveat here, as you have understood from your working capital course, that cash is a part of the working capital or working asset. Okay, so cash is also one of the components of working capital investment. Cash is also part of the working capital investment, but here we are determining the cash flow. So that, or we are projecting the cash flow, and cash cannot be part of this working capital here. So what is the caveat here? When we are estimating the current asset, or when we are estimating the current liabilities for getting the working capital, cash cannot be here. And again, another thing you like to note, that is, there might be some financing component under the current liabilities. Can you recall that there are some financing component in the current liabilities from your understanding of the reformulation of balance sheet? Can you recall what may be the items under the current liabilities which are the financing item other than the operating item? Yeah, short-term borrowing. Short-term borrowing, yeah, that is a very good example of the financing item in the current liability. So the financing item that should be accounted in the financing decisions, and we cannot uh, include this here. We cannot include this here in the current liabilities projection. There will not be any, what would I say, more precisely, the short-term financing, like the current portion of long-term debt, or it can be short-term borrowing. This cannot be part of the current liabilities here, because that will be part of the financing amount that will be reflected in the financing decisions. Okay. So someone is asking for the cash receipt and non-cash receipt examples of non-cash receipt. Okay. So I'll give you the examples in the next class. Sorry, not next class. Now in the next slide here. Okay. So there are a number of adjustments which will be part of the NCC, Okay. So one thing very clear, which is the amortization for intangibles. We have the amortizations. For intangibles, we have the amortization, and that amortization is a non-cash expenses we have to add back. And when you have someone when asking for non-cash receipt, that non-cash receipt is to be subtracted. Okay. So out of the amortization, the amortization of bond discount can come here. The amortization of bond premium can come here. Okay. So when it is the amortization of bond discount, it is the non-cash expenses. It is the non-cash expenses. So if it is the non-cash expenses, in that case, what we have to do? We have to subtract or we have to add back. Bond discount, you learned about it from your financial reporting analysis. We have to add back this non-cash, non-cash amortization of bond discount. Now, the opposite one, the bond premium, you have issued the bond in premium. Now you want to amortize it. In that case, it is the non-cash expenses or non-cash receipt. Amortization of bond premium. Is it the non-cash expenses or non-cash receipt? Non-cash receipt. In that case, what we have to do? In the adjustment, we have to subtract or we have to add back. The answer is we have to subtract. Okay. So who was asking for the examples of non-cash receipt? The classic example is the amortization of bond premium. Amortization of or the bond premium or amortization of bond premium. It is a non-cash receipt. It has no cash consequences. It has cash consequences when it was issued. When it was issued, it has cash consequences. But later, when you are amortizing in the income statement, it has no cash consequences. Okay. Similar thing might arise in the capital gain. Capital gain is a here you see the non-cash receipt, and in the restructuring income there will be non-cash receipt. Okay. Let me take you to another example for this kind of adjustment part. Employee option exercise. Employee option exercise. What happens if employee exercises stock options? What happens to the cash flow of the firm? if the employees exercise their stock option, if the employees exercise a stock option, don't you think that employees pay cash? Employee pay cash to the firm. Employees pay cash. It is not altogether. It is not altogether free of cost. It may be, say, stock is trading at 50 taka, and I'm giving you the option that you will be able to purchase the stock at 20 taka. So you will have cash inflow. You are a firm, you have a cash inflows for 20 taka. Okay. But the employee is getting a stock of which market value is 50 taka. Okay. So here employees make cash payment to the firm and firm receives cash inflows, and that should be added. That should be added. Okay. Now, someone is asking for, sir, why we do add back non-cash charges. That is okay. I wonder how this question comes. Okay, fine. What we are doing, we are taking the, we need to have the free cash flow to the firm. Okay, we know that it is equal to the net income plus non-cash charges plus interest after tax, then fixed capital investment, working capital investment. Okay. Yeah, you see that it is the cash, non-cash outflow, but you want to have the free cash, you want to have some numbers for cash flow. So don't you think that you have to add back the expenses for which you didn't have any cash outflow? When you calculate the net income, you subtracted some expenses for which you didn't have the cash outflow. Right? The very basic, very basic concept, right? So we have the, I mean, we have the net income, which you calculate by subtracting some expenses which are not the cash outflow. So for getting the cash flow, we have to add back all the non-cash charges to the net income to get the free cash flow or to get the cash flow number. Okay. Okay, someone is asking, employee option exercise, how it is a, let me check the question again. If employees pay cash for the option, then how is it a non-cash item? Okay, try to understand. Here, all items which have been listed are not purely non-cash item. There will be some item for which cash transactions happen, but it has not been adjusted. So that's why the employee option exercise, it has for the cash, if cash is received for for exercise of employee option, in that case it will be added back. But if the employees are given option to have the stock at free of cost, in that case there will be no cash consequences. Okay. But what I said, if employees pay cash, in that case, if employees pay cash, in that case it will be added back. Okay. If the employees does not pay, cash, in that case it will not be added. Okay. Now, for deferred taxes, if there is a likelihood of yield for which you are making analysis, there is a likelihood that firm has a bargain, that firm can make deferred tax liabilities, firm can make or firm can create the deferred taxes for longer term. In that case, firm will be able to use the deferred tax, and in that case, it will be added to the net income. Okay, but if there is no proof that firm will be able to defer the tax liabilities for longer term, in that case, it will not be added. Okay, so let me check your questions. If firm employee exercise option at 30 taka when the market value is 50 taka, should not this adjustment be made for 20 taka, which is not got by the firm? You want to make adjustment for 20 taka. For what reason? Here we are wanting to say that firm should make adjustment for that amount of cash which has been received by the firm, Okay. Now, can you explain the meaning of deferred taxes, Habiba? So I believe that you got familiarized how deferred tax assets and deferred tax liabilities arise. You have been familiarized with these concepts in the financial reporting course. Okay, that is the part of the financial reporting issue, and that generally arises for the differences of the tax statement and for differences in the financial statements. And we follow different standards. We follow tax standard for preparing the tax financial statements, and we follow the accounting standards for preparing the financial statements, right? So often we see the differences between the taxes, what we account in the financial statement for financial reporting purpose, and the tax amount what we show in the tax financial statement or tax statement. So the difference creates the deferred tax assets and the deferred tax liabilities. Okay, so you will have to review this part in more detail from the financial reporting course. Okay, so I'm not adding more explanation here. So as I was saying in the beginning, that there are some financial statements number which often people use for estimating the free cash flow. So some examples are earnings before interest, taxes, depreciation, and amortization. Okay. So you see the free cash flow to the firm can also be calculated if we have the EBIT number and if we have the EBITDA number. So these are purely from the financial statements. So EBIT number, this EBIT number is calculated before charging the interest expense or after charging the interest expense? It is before charging the interest expense. Okay. So note that we are trying to understand the free cash flow to the firm. So how can we get the free cash flow to the firm from the EBIT number? Okay. So if we add the depreciation amount, as depreciation has been subtracted when we calculate the EBIT, we already have subtracted the depreciation. Now you might ask the question that what is the reason that we are adding the depreciation? The answer is same, that we are adding the non-cash charges. Okay, but here you see that it is after tax. let me write it clearly. EBIT after tax. EBIT after tax. Okay. Now you might ask that what it actually indicates. It is the after tax operating income. Can you see that we have not added the, we have not subtracted the interest expense. We have not subtracted the interest expense because we are determining the free cash flow to the firm. We are determining the free cash flow to the firm. So this EBIT after tax includes payment to the debt holders, and it will also include the payment to the equity holders, but still we need to account for this free cash investment in fixed capital and investment in working capital. So in this way, we have taken this number from the financial statement, and we know that what has been subtracted and what has not been subtracted here. Okay, so these items are similar as before. Okay, so you have to make subtraction for investment in fixed capital and investment in working capital. Now, instead of taking the EBIT, which is more precise definition of cash flow, is the EBITDA. That is the EBITDA. If we take the EBITDA and it is after tax, in that case, we do not need to add back the depreciation. What is the reason? Because depreciation and amortization has not been subtracted. So it is the before charging the depreciation and amortization. But other two things are same. Other two things are same here. Okay. So these are the some ways that how can we use the variable from the financial statements to come up with the free cash flow. Okay. So EBIT and EBITDA are good, not EBIT, but EBITDA. EBITDA is a good proxy of operating cash flow, but it is not the real proxy. Okay, what's the reason? If I say this portion, if I say this portion, let me please. If I say this portion up to this, if I say this portion as the as the operating cash flow, as the free cash flow, what will be the wrong? The wrong will be I have not adjusted for investment in fixed capital, investment in working capital. But one caveat here, when we are taking the EBITDA, we cannot add back all the depreciation amount. We can only account for depreciation tax shield. Depreciation tax shield, from with which you are familiar from the CID codes, right? So depreciation tax shield, what does it mean? Depreciation tax shield, is it the benefit or the cost? Depreciation tax shield. Depreciation tax shield, it is the benefit. It is a kind of, what kind of benefit? It is a kind of tax benefit it provides us. Okay, so we can use the EBIT or EBITDA number to come up with the free cash flow to the firm. And finally, what can we do? Often people take the cash flow from operations from higher cash flow from the operations is available in the financial statements. Cash flow from operations, it is available from which part of the financial statement? It is available from the cash flow statement, right? So this cash flow from operations, if we start with the cash flow from operations, can you recall that IFRS and the US GAAP allows us to subtract the financing expenses and to recognize it in the part of cash flow from operations? Can you recall that IFRS allows us to include the financing expenses in the part of the cash flow from operations? Now, you see, if I include something in the cash flow from operations, something is what? Something is payment to the debt holders or capital providers. Okay. In that case, we have subtracted the interest expenses. Now, we are determining what? We are determining free cash flow to the firm. So to determine the free cash flow to the firm, what we need to do? We need to add back the interest expenses, what we already have subtracted, or we can ignore it. We have to add back. Try to understand, it is not something non-cash charges. Okay, it is the cash charges. It is the cash charges, but it has been accounted in the cash flow from operations. But free cash flow to the firm is saying that it cannot be part of the cash flow from operations. That's why we are separating out. We are separating out the payment to the debt holders, and we are separating out. How we are separating out? Because it was subtracted to get the cash flow from operations. Okay, so we have the cash flow from operations, and what we are doing, we are adding back the interest expenses after tax because it is available to the capital providers or the debt providers. Now we are subtracting the investment in fixed capital. Investment in fixed capital, and it is investment in fixed capital. It is required for the sustainability of the firm. Okay. Now, finally, what can we do? We can come up with the free cash flow to the equity if we have the free cash flow to the firm number. How can we come up with the free cash flow to the equity if we have the free cash flow to the firm number? Okay. If we have the free cash flow to the firm number, we know that it includes something which has payment for the debt holders. So what is the payment for the debt holders? Payment for the debt holders is this amount. Interest expenses after taxes. This is available. This is only for the debt holders. So we are subtracting it out from the free cash flow to the firm. Note that you have the free cash flow to the firm number available. Now we have to make an additional adjustment for the net borrowing. Now, are you familiar with this kind of calculation, why the net borrowing is added back? It is not something like the non-cash charges. It is purely the cash inflow. It is purely the cash inflow. Net borrowing has been added back. Okay, so as the time is short, let me explain it here. Okay, net borrowing is added back. Have you learned that firms sometimes borrow? Firms sometimes borrow to make payment to the equity holders as a dividend or as a purpose of making payment for the merger and acquisition. Have you heard about this? The firm receives borrowing to make payment to the equity holders. Okay, but what I'm trying to say, let me summarize here. When firm make borrowing, firm receives some cash very purely, and this cash is available to the equity holders for distribution. Okay, obviously you can use it for different purposes, but it is available for the, if you do not have other purposes, this cash is available for the equity holders. That's why when you make the calculation for free cash flow to the equity from the free cash flow to the firm, we add back the net borrowing. Net borrowing from where? From the debt holders. But we subtract the interest expenses payment to the debt holders. Subtract from where? Subtract from the free cash flow to the firm to get what? To get the free cash flow to the equity. Okay. Now you see that we can link up the definition of the free cash flow to the firm, what we learned earlier, that we know that this amount, we already have worked with this. We already have worked with this. What is this? This is the free cash flow to the firm. Okay. Now, if we want to make adjustment in this equation for getting what? For getting the free cash flow to equity, how can we make adjustment? We need to remove this. We need to remove this part. Okay. We need to remove this part. And we have to add back. We have to add back the net borrowing. When? It is the free cash flow to the firm or is the free cash flow to the equity. Now you see, net income is here, non-cash charges is here, and the investment again is here, and net borrowing has come here. It's this part. Okay. Again, similarly, what I was saying in the previous slide, that we can make the estimation of free cash flow from the cash flow from operations in the final from cash flow statement. We can make the similar adjustment. What can we do? We can ignore this. When we are estimating the free cash flow to the equity. But what we have to do, when we are ignoring it, we have to add back the net borrowing. We have to add the net borrowing. Okay. So these are the some ways that how can we come up with the free cash flow to the firm and how can we come up with the free cash flow to the equity. Have we got the reason that why net borrowing is added? Have you got the reason why net borrowing is added? This net borrowing is available to the farm use debt. Farm use debt for making payment to the equity holders, and that is the reason that why net borrowing is added. Now, if you understand this, let me ask you the follow-up question to finish the class. Okay. If the firm, okay, you have the FCFF. Now I'm saying that firm has some preferred equity. Now, how can you make adjustment for preferred equity to the free cash flow to the firm to get the free cash flow to equity? How can you make adjustment? How can you make adjustment to the free cash flow to the firm to get the free cash flow to equity if I say the firm has issued some preferred equity? You have to, again, in a similar way, you have to add the receipt from the preferred equity holders, and you have to subtract the preferred dividend. Have we got it? If the firm has the preferred equity, to get the free cash flow to the equity, out of the free cash flow to the firm, the receipt from the preferred equity holders is to be added, and the payment to the preferred equity holders need to be subtracted. Okay. So try to understand the logical reasoning behind this equation. Otherwise, we will commit mistake for sure. Okay. So let me end here. We'll discuss on the remaining issues in the next class.